Hey guys, Keel here. Welcome back to another weekend edition of The Trading Edge. Hello, YouTube members as well, as I'm probably going to share this on YouTube since I don't feel like producing two videos this weekend. If you guys are new, I'm a Forex trader, trading coach, one of the co-founders of Tier1Trading.com. Now, I don't have a lot to talk about today. It's going to be short and sweet. We're going to take a look at the euro dollar. We're going to take a look at silver. And that's mainly because we had a hell of a week. It was a busy week in the market. We had a lot of setups that played out very nicely. And now the market's kind of taking time to reset, move to that next important point. And hopefully we have time either this week or next week to reevaluate and maybe find some more situations. So for you guys that are out there that kind of believe the myth that summers are slow, summers aren't necessarily profitable, that's not the case. You just got to be a little bit more patient and wait for the right opportunities because they don't come as often. But before we hop into the two pairs I want to talk about, I want to have a little bit of a conversation because something's been on my mind. And I got the comment the other day after sharing a podcast episode on Twitter about how you should focus on the now and not necessarily focus on the future. And I just think that's a very bad way of thinking, and I'll explain why. The podcast was actually one of the accountability sessions shared by a member of our platform, Chris, and I loved it because his story reminded me a lot about mine, and the fact that he was working a lot, working lots of hours, putting in that grind, but making a fair share of money, and he was, I don't want to say comfortable, but he was okay with what he was doing. And then he listened to a podcast episode and he had a wake-up moment where he realized, like, man, I can be doing a lot more. This life that I'm living right now isn't as good as I think it is. And that was a big moment for me as well. You know, when I first got into trading, when I was kind of struggling and not taking it seriously, I was working 3 jobs, right? And I was making about $35,000 a year, which is more than I've ever made in my lifetime. So, you know, I'm just out of college. I owned a rental property where I'm renting out one unit. I'm living in the other unit with 3 roommates, so I don't have to pay rent. I'm actually making a little bit of money each month off the property. No family, kids, or anything like that. $35,000 is more than I knew what to do with. So, and I was very comfortable. But I had a realization, and I thought about the future. You know, what happens when I get married? Do I want to still live in a multi-unit and share it with 3 roommates? No, we probably want to get something of our own. I was starting to get tired from working 18 hours a day, and I started thinking about how my life would be 10 years in the future. And I realized that, hey, what I'm doing right now, $30,000 with a family, isn't going to cut it. And that was kind of the wake-up call that I needed to push forward. So the problem with thinking about the now is that you get comfortable. You don't really prepare. And I guess to give a good example is, you know, think about credit card debt, right? I think we've all been in a position where we've used credit cards and maybe we've acquired some debt, right? When does your credit card debt situation become urgent, right? Once you're in debt, right? Once you see how much you owe, once you see how much those interest charges are, right? Once you're in the hole is when you really start to take it seriously about climbing out, right? Once you're in so much debt that you have to take massive action because you've reached that pain threshold, that's when you really start putting forth the action of climbing out of it. And climbing out of it is hard because the longer that you've been in that debt, the deeper that hole is, the more interest you're getting charged each month on top of what you already owe, right? And it's harder and harder to do something about it. That's a good example of kind of the hardships that come if you just focus on the now. But if you focus on the future, you can prepare well in advance before that. You can see your situation. You can create a plan on how to better your situation. You put yourself in just a better place. And my thought process is always this, right? I'm really big about the now, right? My goal in life is to win the day. But we need to have direction, right? Thinking about the future, preparing for the future. Where do I want to be? What do I want to accomplish? What's my dream life? That allows you to set up the really small daily goals and give you direction of, hey, what do I need to do now? What do I need to work on very urgently, very aggressively now in order to be where I want to be at in the future? Because if you don't, you're doing nothing more than running on a treadmill, right? If you run really, really fast on a treadmill every single day because you're attacking the moment, you could run for 10 years and guess where you've gone? Absolutely nowhere, because the treadmill does not move. You need to go in some sort of direction, even if it's moving, 1 degree in that direction of that future goal at a time. At least you're making progress for that future goal. So don't get stuck worrying about the now and being comfortable and saying, I'm just going to do everything I can do now because we don't know if we're going to have it tomorrow, right? That's a stupid way of thinking, in my opinion, right? Have a goal, have a direction in where you want to go for the future, and then work extremely aggressive in the now to push you towards that goal. So nothing to do with trading, but again, it was based on a trading related podcast and just something on my chest. And then this is my video, so I can do what I want. All right, so enough of that. I probably scared away the people that aren't interested, and that's good because we don't really want you guys following me anyway. Let's hop into the charts. We're going to take a look at, let's go euro dollar first, and then we'll head over to silver next. All right, let's hop into the chart, starting with the euro dollar. This has been a very interesting pair for me because it's one where my longer term predictions have been wrong, yet my shorter term actual trades have been right. And, if I had to be on one side, I'd rather be on that side than the other side. But if you've been following me for a while, right, I've been thinking a bearish move on here, right? We came up in the previous structure. We had some nice wicks to the upside, and we did take a few shorts in here, but never got to follow through that we anticipated. And for you guys that are new, there's a big difference between making a prediction and actually taking a trade. And I think a lot of traders don't understand that. You're going to make a lot of predictions in the market. Out of all those predictions you make, very rarely are you going to get a trading opportunity, because not only do you need to make a prediction, which is what we're doing each and every day in the market, but then you need to wait for the market to give you confirmation, and then you need to wait for your specific entry reason, and then you need to make sure the risk reward all lines up. So there's so many moving pieces that go into taking what we call a good trade. And that's why when you talk to professional traders, they'll tell you that good trades don't come too often. And when you look at the differences between seasoned vets, I guess you can say, and newer traders, typically the frequency is a lot lower for those with more experience. They know what they're waiting for, and they're not too anxious, I guess, to maybe anxious is the wrong word. They're not too excited to jump into trades just to be in a position. But anyway, what happened here on the euro dollar is important, because if we go back to our IPD process, IPDE, and you identify what we've just done is we've just taken out our previous structure highs, our main previous structure highs right here, and even a past previous structure high as well, giving us a higher high, higher close. With that being done, we can then make the prediction that price action is likely to continue higher. And the next step is we want to identify where price action is likely to continue higher too. And that's going to be this level right here. If you guys are over on a Ninja Trading platform, you're probably gonna have a nice VS1 level right here as well. So this is where I would expect the euro dollar to go next, really this 117.50 to 118 level. Now, since we have that prediction, now the next step is asking ourselves, well, okay, how can I get involved? And there are a few ways you can do so. It's gonna be different depending on your personal preference as a trader. There are breakout traders, there are pullback traders. Let me mute the phone real quick. Sorry about that. There are breakout traders, there are pullback traders, all types of sorts. So you want to find the style in which you've perfected, or the style in which you pursue. For me, I like being a pullback trader. So what I'm looking for here, and we'll slide down to the daily, is for one of two things, right? One, looking for, I guess, one thing, and you can look at it on a daily or the 4 hour, but essentially I'm looking for a pullback, some relief, right? Price action is overbought. This doesn't mean that price is going to reverse. I'm not interested in selling at all. But it could mean that we may see some short-term relief in the market where we put in a little bit of a pullback, a little bit of a retracement, and that's what I'm looking for to project that next move forward. So looking for price action to pull back into previous structure resistance, which I'm hoping now acts as support, and looking for an opportunity to trade it up into this zone. And real quick, if we just take a look at, it's a little bit early to do anything with Fibonacci's, but if we kind of get out ahead of this just in advance, we can always adjust later. If we take a Fibonacci extension from our previous swing low to our swing high here, and again, if this high moves, we'll have to adjust the Fibonacci with it, we can start to get a clearer idea of maybe where we want to take targets within that zone. So you can see a 127.50 Fibonacci extension is going to line up right at that 118 level. Again, that's an even handled number right in the middle of our structure zone here. We could even do this. I haven't done this before, so let's see if this actually works. One-to-one measured move is going to line up a little bit above that level. Probably if I would have taken it from here, but this is the real swing low. And let's see if we have a longer term Fibonacci as well. Swing low to swing high. Kind of this last move higher. 1618, a little bit above that. So you can see we have some pretty good confluence between an AB equals CD pattern, a one-to-one measure move, and a 1618 Fibonacci extension. For me, I always kind of default to structure. Structure is the most important thing in my philosophy. So I do use fibs, I do use equal measured moves, I do use a lot of other things in the market, but structure is always going to be the most important thing. So if I had to make a decision between looking for targets up at 118.62 and 118 even, I'm going to take that 118 even, especially, considering the case that, if you're taking this move from, let's just say a 116 even handle, who knows where it's going to come down to, and you're looking for a move to 118 versus 118.60, is 60 extra pips really worth that risk? Right. I'd rather let the market have those 60 pips or keep those 60 pips and put myself in a much safer position as far as targets. And that's kind of my conservative nature as a target taker, but it works good for me. I don't like to be too greedy. I have no intentions of catching, quote unquote, the full move. I want my piece. I want to get out before I get burned. And that's how I've been able to have success over the years. So Euro dollar, look for a little bit of relief this coming week. Who knows when or if it will happen, but if it does, hopefully you're prepared to take advantage of it because it could be a pretty decent move to the upside. Now, next we're going to take a look at silver, but I want to start off on gold because the silver situation is going to be similar but not the same as what we looked at on gold this past week. And for you guys that didn't, either join the live room or watch the recordings, I'll kind of give you a brief kind of breakdown of what we saw here on gold. So first and foremost, these pink lines are going to be our previous levels of structure. So I may need to go back out to the weekly, and you can see that this purple line right here, this was a previous structure high. And again, I always want to identify where's structure at. It starts my whole process of IPDE, identify what the market has done, where we're trading at, and allows me to make my prediction. And price was trading above our previous level of structure. And we started consolidating, in which is a very, 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 very good breakout pattern called a high and tight flag. It's essentially a sideways channel. And there's no kind of common terminology in trading, which I guess could be a negative for newer traders because you may look at the same thing and hear three different names. If you're experienced, it doesn't really matter what it's called as long as you know what it looks like. But basically, we're looking at a break of structure here, and we're looking at a sideways movement, and we're expecting a breakout in this situation. Now, whenever we get these kind of channels or flags or whatnot, the breakout technically could be either way. There's no guarantee that it's going to break out in the preferred direction. But what we want to do is two things. We want to do overall analysis, and that allows us to make a prediction on which way we're more likely to break out. And then we want to put ourselves in a good risk management position where when we're right, we capitalize more than what we lose when we're wrong. And that's the essential kind of game of trading. I think many new traders come in, they think trading is about, I have to be right all the time. And you don't. It's not about that at all. You don't have to be right all the time. You don't need to make all the pips. You don't need to, have a very, very small stop loss. It's about two things, right? It's about putting yourself in the favorable position as far as your probabilities go. And technically, you don't even have to do that. You can be a lower percentage trader and still win. But consistently putting yourself in a position where you're more likely to be on the right side of the market than not. And then when you put yourselves in those positions, managing your risk, right? Making sure your risk is smaller than your reward. That way you don't have to be right 90% of the time to be profitable. You can be right a handful of time and make some good money. And the times that you're not, it doesn't really hurt you because you're not losing that much. And that goes on to help your psychology as well. Because when you can stomach losses, I think a lot of people are scared to take losses because it hurts, right? They lose money. They don't like losing money. But if your losses are so small where you just don't care, right? It's not going to bother you. Think about it like the difference between, you walking out of the store and you dropping a $50 bill on the ground versus you dropping a penny and you go home and realize it, right? if you lost a $50 bill, right, you're probably going to be pretty upset. You're probably going to be upset. You're going to be frustrated, and it's going to stick with you for a while. If you drop a penny, you're just brushing it off like, I don't care. So it's very similar to that. But what we're looking at here is we're looking at actually setting ourselves up at the bottom of this range because the breakout, the projected breakout, was in our preferred direction. You can see it gives you a very minimum risk because you know exactly where you're wrong. You don't have to, market doesn't have to move too much for you to be wrong. And the reward is pretty significant going up to our next projection level. And if you can do this, you're going to be in a great position. Now, I show you this because silver is not in this same position. So you may not want to be as aggressive. Silver, if we go out to the daily, you can see my pink line in there already, right? When we do our identification stage, I may need to go out to a weekly here. When we do our identification stage, let me just make this a little bit clearer for you. Weekly is probably a better place to go, but let's delete all this. Let's go down to this level here. We do our identification and we see previous structure. Sorry, wrong place. That's a projection. Give me a second, guys. Here we go. Let's go down to where silver's currently trading at, right? And you can see we're trading at a previous level of structure right in here, right? We've tested that level. I'm going to zoom in to make it easier for you. Sorry. We've tested that level, but we haven't broken and closed above it. So the fact that we haven't broken and closed above it doesn't allow me to make that same prediction that we had on gold where I can say, hey, we're more likely to continue higher. I can think that based on the setup, and I can set myself up in a trade that would take advantage of it, but it's not as clear as an opportunity as gold was. Does that make sense, guys? I know we're not live and you can't actually respond, but like nod your head in agreement or leave a comment if you're on YouTube, if you're in agreement. I hope that makes sense. And that's judging or just grading the differences in opportunity. And that's the kind of difference between what would be a grade A opportunity and, maybe a grade B opportunity. So what we're having here, keeping that in mind, what we have here on silver is we ended the week with an inside day, right? This is called an inside bar, this little green bar right here. And it's a bar that completes 100% within the range of the previous candle. So if you look at this red bar, this is something called the mother bar, right? The previous day, the highs and lows of the previous day. On Friday, we completed completely within that range. And typically when you see these inside bars, you would expect a breakout, right? And of course, whenever you expect a breakout, you're expecting it one way or the other. If we had that true kind of projection that we're more likely to continue higher, I would encourage you to do the same thing we did with gold, where set yourself up with a position at the bottom and wait for that breakout. And you can still do that. It's going to be a little bit more risky. But in a situation like this, maybe you want to wait for some confirmation. So maybe instead of just taking a position now and waiting for the breakout, because we're at structure, maybe you do something where you wait for that breakout, similar to kind of like what we looked at with euro dollar, where now you wait for that breakout. That's going to give you confirmation of the break and close. Wait for that pullback, or if you're a breakout trader, trade it right away, whatever your thing is. Wait for that pullback and then look to trade it up. So similar type of pattern, but because there are different market conditions, you should probably be treating it a different way. Now, as far as projections go, where we can look for a price to go to with silver, I know people are making big calls. I'm hearing rumors, silver, $50 out there. This has kind of been the hottest thing on the market lately, even more hotter than gold, if to be honest with you. But if we want to take a look at where price is likely to go next, all we have to do is look left. Structure leaves clues, because we had a nice ascending triangle in the past here, right? We had this type of situation. We had price action hold at support before finally breaking through. And this is where I would expect price action to make its way to if we can break higher. So this is kind of the next destination. Let's call it 26 bucks, 26 even. And we can add some Fibonacci confluence to that as well if you want to take a Fibonacci retracement from our swing high to our swing low all the way down there. You can see we're going to have a 3-2 Fibonacci retracement as well. So a decent Fibonacci level there too. So that's a good place to make your projection, to make your prediction. There are some smaller levels that we can pay attention to. One's going to be right here around 25 cent. Let's call it that. So if you're a little bit more conservative, maybe you aim for that instead. But I think 26 bucks is a pretty a pretty good projection on where silver can go to. Now, again, it doesn't mean it's going to go right there. We could see some relief, and that will be good because that's going to give more opportunities to buy at a much cheaper price. But look for a move from 22.70s up to about 26 evens here on silver. So that's it for today. Short and sweet. Tier 1 members, I'll see you guys in the Monday Q&A. I've been speaking to a few traders. Hey, if you're on the platform and you haven't been watching those Monday Q&As, do it. Especially if you're sending me questions about kind of stuff that we go over in the foundation course, whether it's reading a price chart, whether it's kind of understanding the difference between identifying double tops and double bottoms and actually trading double tops and double bottoms, right? If you can't make them live, right? If you can make them live, you should be there live. There's no excuse. But if you can't make them live, remember, they're all archived, right? Go to Knowledge Base, go to Q&A sessions, right? Scroll through them. I have little notes on everything we talk about. So if there's a specific kind of deal that you're looking for, you can look through and see it, right? If it's something that you're not worried about yet, you can leave it for later, or I'm sure we'll talk about it in a future Q&A. But if there's something you're interested in, make sure you watch the recordings. I would do it each and every week. These are the most powerful sessions we do, and you are missing out in your advancement of learning how to trade if you're not watching these. Trust me. So make sure you do that. Also, if you're brand new, if you're watching on YouTube, because I think I am going to put this on YouTube, make sure you sign up for that trial membership, 14-day trial membership. Usually I say you get access to one course. Apparently, you get access to 3 courses. You get our emergence course, you get our trade to measure event, you get our emergence 2.0. So you can watch all of these during your 2-week period. You can interact with the chat. You can join us in the live rooms. You can download our software, all that fun stuff. It's 14 days. It's $1. And the question you need to ask yourself is it worth investing $1 to become a better trader? The answer is yes. If not, you're totally not serious about trading. Doesn't mean you need to stay with us, but at least use this opportunity to better yourself. And there's no rebill or anything like that. Your account is strictly just canceled after 14 days and you lose access. So hope you guys have a great rest of your weekend. Hope you guys have a great week of trading next week. And until next time, plan your trade your plan. Take care.